Hello everyone, let me introduce myself. My name is Bramasto. Currently, I'm studying MBA program at IPMI International Business School, which at this time, this video when it's created, IPMI just transformed to IPMI Institute. Congratulations! Now this video, I would like to discuss on corporate finance course was taught by Prof. Sembel. The process of learning corporate finance I summarize into mind mapping diagram. So let's discuss about the mind mapping of corporate finance. So pardon. Okay, so in this mind mapping, we will discuss about first is corporate finance overview. Second, financial management, corporate governance, ESG, and then investment strategy, then financial risk management, tax benefit and dividend policy, financial management principles, and lastly, expert strategies. In first discussions about the corporate finance overview, corporate finance focus on maximizing company financial resource, both internal and external, to create sustainable value. This involves understanding of business process, internal management practices, and external perspective. All these factors are essential in making sound financial decisions. Here are some key aspects of corporate finance. First, asset and liability management. Striking the right balance between the company resource and its financial obligations. And then how to formulate dividends policies, and then in investment strategies is identifying, evaluating potential investment opportunities to maximize returns and minimize risk, and also learning about fraud preventions. And then in financial management, effective financial management is fundamental in creating sustainable value, which involves strategically managing financial resources to increase shareholders' wealth. Financial management contains three main parts which all focus on value creation. First is business process. This involves understanding the company operation, financial performance, and the competitive landscape, which focus on using financial data to assess the viability and profitability of the company's business model. And then in internal management, this focus on managing the company internal financial resource, including assets, liability, and cash flow. It involves making decisions about capital budgeting, financing, and working capital management. And then in external perspective, this considering the external factors that can impact the company's financial performance, such as interest rate, economic conditions, and regulatory changes. It involves understanding company financial position in the broader market context and making decisions about dividends policy and investor relation that we'll discuss further in this video. And then in corporate governance, we understanding which balance to balance the interests of all stakeholders while ensuring value creation through effective management of assets. This approach incorporates key principles like the triple bottom line will consist of profit, people, and planet. In profit, focus on framework that measures the company's success not only in terms of finance performance, also social responsibility, which include in the people, and environmental impact, which include in the planet aspect. And then four cornerstones from McKinsey, which guide sustainable business growth with strong financial performance and profitability, operations, efficient and effective operation, customers, excellence, customer service and satisfaction, people, engaged and motivated employee. Then corporate value, the guidance principle that shape a company culture and decision making. This can be tangible or intangible. Intangible, as we know, is such as innovation, quality, and intangible. As we know, is for example, like integrity and collaborations. And in ESG discussion, environmental, social, and governance, which factors are essential drivers for creating value across multiple dimensions. First, financial ESG consideration might lead to improved financial performance by mitigating risk, generating responsible investments, and enhancing brand reputations. And then understanding customer through ESG. Strong ESG profile can appeal with customers who prioritize sustainable and ethical practices, leading to increased customer loyalty and advocacy. And then business process. Integrating ESG consideration into business process can improve operation efficiency, reduce waste, enhance innovation. Eventually, this will result in reduction on expenditure and improving productivity. And lastly, learning and growth. ESG stimulates a culture of continuous improvement and innovation within the organization. This encourages employee engagement, attract talent, and promote knowledge sharing, which contributing to the company's long-term growth and resilience. And balanced scorecard approach can help organization effectively measure and manage this diverse aspect of value creation by setting clear objectives and tracking progress across financial, customer, business process, and learning and growth perspectives. This approach provides a true understanding of how ESG contributes to financial goals, which is meeting financial target and satisfying investor expectation, customer's perception, enhancing customer perception of product or service quality and affordability, and lastly, business process optimization, of improving the quality and efficiency of internal process. And then in investment strategy discussion, investment strategy plays a crucial role in achieving financial growth and stability. Key components of this strategy include capital budgeting. The process involves evaluating and selecting long-term investments that align with company's financial goals and risk tolerance. By carefully analyzing potential projects and their expected returns, business can make well-informed decisions regarding the allocation of resources. And internal rate of return, or IRR, is a metric used to assess the profitability of an investment. It calculates the discount rate at which the net present value (NPV) of all cash flow from a project equals to zero. A higher IRR generally indicates a more attractive investment opportunity. And lastly, financial risk management. This involves identifying, assessing, and mitigating potential financial risks that could negatively impact a company investment. Strategies such as diversification, hedging, and insurance can be employed to minimize losses and protect the company's financial interests. And in addition to these strategies in financing, consideration also play a crucial role in effective investment planning, such as optimal debt level, finding the right balance between the debt equity. Financing is finding the right balance between debt equity financing is crucial for maximizing returns and minimizing financial risk. Too much debt can increase interest payments and financial distress. Meanwhile, insufficient debt may limit the potential for growth. Tax benefit is understanding tax implication of different investment options is essential for optimizing after-tax returns. Tax deduction, credit, and other incentives can significantly impact the overall profitability of investment. And then in financial risk management, discussing navigating to complexities of financial risk management requires a deep understanding of several key areas, which include international finance. The global economy is interconnected. An event in one country can have effect across the world. Understanding international financial markets, exchange rate, and geopolitical risk is essential for managing a company exposure to global economic fluctuation. And then in marketplace management, companies must adapt to ever-changing market conditions, including competitor action, consumer preference, and regulatory changes. And also understanding about foreign exchange. And lastly, understanding corporate risk management has been significantly improved through studying a real-world case studies. These studies offer valuable insight into how companies have effectively managed financial uncertainties. This case study demonstrates the practical application of risk management strategies, emphasizing the significance of proactive planning, adaptability, and comprehensive understanding of financial landscape. So the management still need to learning from the case study, from the journey that already existed. And then the tax benefit and dividends policy significantly impact value creation. Understanding their effect on shareholders' equity and overall tax benefits is crucial for making informed financial decisions. From an investment perspective, it's essential to understand correlation, risk diversification, and efficiency portfolio management. And in financial management principle, key financial management principles include the time value of money and rule of 72 for doubling investment. In time value of money, this fundamental concept highlights the money available today worth more the same amount in the future due to its potential earning capacity. This principle underlines investment decision, emphasizing the importance of calculating present and future value for accurate financial planning. Rule of 72, this simple rule estimates the time it takes an investment to double in value by dividing 72 by the annual rate of return. Investors can quickly assess the potential growth to their investment. In addition to this core principle, various analysis methods are crucial for successful financial decision making. First, fundamental analysis. This method used to evaluating company financial health, industrial trends, and overall economic condition to determine its actual worth and potential for growth. By analyzing factors such as earning, revenue, assets, and liabilities, investors can make well-informed decisions about buying or selling stocks. Second is technical analysis. This approach focuses on analyzing historical market data such as price, volume trends to anticipate future price movement. And lastly, financial statement analysis. This involves examining a company financial statement, including the balance sheet, income statement, and cash flow statement, to assess financial performance and identify potential risks or opportunities. And from the expert strategies, we can learn a lot from financial experts such as Benjamin Graham, Philip Fisher, John Williams, and Warren Buffett. Understanding fraud risk management and the potential financial action to manipulate performance has the highest priority. The use of ethical practices, rigorous controls, and robust security measures is crucial in preserving the integrity of financial management and preventing acts of fraud. So, in conclusion, it's clear that good corporate governance and effective financial management are the cornerstones of building sustainable value. By integrating a deep understanding of this principle into business process, companies not only achieve a long-term financial success but also ensure the satisfaction of their shareholders. So, thank you for your attention. I hope learning something on this journey through the word corporate finance. Also, thank you, Prof. Roy. I hope the knowledge will be useful for my future professional journey. So, Good luck, everyone. As my boss always says, Mr. Ola, never give up and keeps on spirit and love. So thank you, everyone, and good luck.